I'd like to introduce the next speaker. Mr. Andrew Szyman has joined us from the UK and from F&C Asset Management. He is the Sustainability Manager and is also on the team with the United Nations Environment Program, the Finance Initiative, the Property Working Group, and is going to share with us some of the practices around the world and the work of that group as well as with F&C. So welcome and thank you.
Thank you. Everybody hear me okay? Good afternoon in that case. We're past 12 o'clock. Thank you for inviting me to speak here. It's a pleasure to be here. I am bilingual, but not in Romanian, unfortunately. And in fact, coming from Manchester, some people would say I'd struggle with English, but hopefully you can understand me in my regional accent. I'll open, because we're an emerging market in the field of sustainability in this region, I'll start off with a phrase which I've used before, and I hope it's not lost in translation. Environmental social governance, corporate social responsibility, it's a bit like teenage sex. Everyone says that they're doing it, most people aren't, and those that are doing it pretty badly. Within the context of the Green Agenda, my presentation is going to focus particularly on the impacts of environmental, social and economic issues, ESG as they've been already shown to me, and the mechanisms that underpin the activity within the commercial property investment field. In essence, what I'm going to talk about is work covered, as Stephen rightly said, by the UNEP, United Nations Environmental Programme Finance Initiative, the Property Working Group, of which F&C Asset Management, the company that I work for, is a member. And in essence, I'm speaking to you on behalf of those two bodies. So perhaps first just two sentences on each of those bodies. F&C is a UK-based asset management company. We're in excess of $200 billion under management, of which approximately $10 billion is invested in property. Our clients include institutional clients, such as Friends Provident and Royal Sun Alliance, as well as private investors through our commercial property trusts. F&C has a long history and pedigree in the area of ethical investing, launching the Stewardship Fund as early as 1984. Today, our Chief Executive Officer, Alan Grisey, is a prominent member of the Business Leaders Group on Climate Change. And one of our directors of the Governance and Sustainable Investments team is a lady called Vicky Bakshi, who was a former policy advisor on climate change to former UK Premier Tony Blair. So what about the United Nations and the Property Working Group? Where did it come from? How is it constituted and what's its brief? Well, the concept was born at a seminar pretty similar to this in 2005, where prominent and committed players were exchanging experiences and ideas. One such gentleman, a man called Carlos Joly, was a key member of an existing property working group. That was the Asset Management Working Group. But he contended that property was so inherently important and so intrinsically different that it merited its own dedicated working group. And the rest followed. The group comprises of United Nations members who have property assets. Participants currently include institutional investors from Europe, from the US, from Australia, Asia, and from India. Truly global. What brings them all together is the desire to promote sustainable development in the real estate and financial sectors. Now we have this slide. The answer is money. What's the question? A cynical view perhaps, or is it in fact reality? Is it sensible to assume that green practices will only be implemented if driven or motivated by financial benefits? In the context of sustainability, some might argue, for example, that social activity is only appropriate when it's consistent with profitability. So a shopping centre, for example, may decide to improve a neighbourhood, but only if it makes the area more attractive to potential customers. More footfall, more income, more profit. Similarly, they might recycle waste if it lowers their disposal costs. Others might take a more ethical position and argue that companies have a moral obligation even if they diminish financial returns. Returns. Return on investment. All investment classes are characterised by their focus on returns, on outperforming benchmarks and indices to satisfy investors, to satisfy stakeholders, to generate more business. If there was any evidence to suggest that risks have been identified, then look no further than the UK and the proliferation of commercial property agents setting up their specialist sustainability departments. Each of them has a common thread to address the risks, but more interestingly, the opportunities presented by this landscape. Perhaps the most urgent and evident of all the emerging risks are those relating to climate change. The evidence is compelling, the consequences are severe. The impacts, as seen by resource consumption, CO2 emissions and flooding, stare us in the face. In the US, we've seen an entire city underwater, and we've seen grid failures related to capacity cause disruption in the UK and continental Europe. Around the world, the direction is clear towards a low-carbon economy, but the destination is a touch fuzzier. How fast do we need to travel towards this destination? This is where management and judgment and business leadership lies, because in assessing all the values that determine the speed of travel, that's where competitive advantage lies. And of course, as this effect works through the economy, there'll be winners and losers. The losers are those that won't understand the significance of these trends and the speed at which they will convert into real-time impacts on business proposals, on return on capital, on investment values. And secondly, those with the power don't have the knowledge, and those with the knowledge don't have the power. Historically, these issues have been subcontracted to technicians, to committed. Remember the Simpsons slide. But not necessarily at those that are making the major decisions. The target must be the investment fund managers, the people that control the money. I'm sure most of you have seen the circle of blame before, the so-called circle of blame, the biggest obstacle for real estate market and reducing the impacts and creating sustainability accountability. It's typically applied to new development, but it's equally applicable to existing stock. For those who can't make out the words, contractors. We would build them, but the developers don't ask for them. Developers would ask for them, but the investors won't pay for them. The investors would fund them, but there's no demand. The occupiers would like sustainable buildings, but there's little choice. I don't propose to dwell on that too much, but suffice to say that there are emerging arguments to suggest that the circle can and is being broken. Green buildings are being developed and constructed at no additional premium. Whilst demand is coming from occupiers for sure, the best organisations and companies, in the form of their own corporate social agendas. And of course, property fund managers, whose values are reliant upon income streams, are chasing these covenants. And they have to recognise that, and they have to satisfy demand accordingly. One of the challenging aspects in the commercial property arena is the indirect nature of the relationships between investors and environmental, social and governance outcomes. With typical corporate equities, investors have more of a direct impact on outcomes because the companies they invest in have direct control over the factors of production. The slide here are those offered by a number of eminent professionals who undertook a recent study into socially responsible property investment. We've touched on a lot of these already this morning. CSR image, being the landlord of choice. Future-proofing, reducing the impact on asset value, all for the investor and owner. And for the occupier, increased productivity. Again, this anecdotal suggestion that we work better in greener buildings. There are lots of studies that have looked into the direct relationship between social and environmental practice and financial performance, but the results are so far mixed. Meanwhile, no published studies have looked specifically at the relationship between financial performance and the general indicators of sustainability in the property sector. Responsible property investing, or RPI, is the contention that property investors can realise greater returns through considering and implementing social and environmental issues and practices. It can be defined as maximising the positive effects and minimising the negative effects of property ownership. The UNEP Property Working Group's early work sought to identify practices around the globe that might assist in demonstrating financial implications of implementing ESG issues across the property investment arena. In 2006 and 2007, the group was looking at 4 areas: practice that applied to a single property without any financial information, practice that applied to a portfolio of properties but not with financial information, practice that applied to a single property but had supporting metrics, and practice that applied to a portfolio with the supporting metrics. The findings are presented in a series of mini case studies called the briefs. And such cases cover a wide area of practice and activity across the whole globe. The briefs literally touch on dozens of property locations, design, management characteristics, because so many geographic, design and human elements contribute to the social and environmental performance of buildings. To simplify, the briefs offer 10 dimensions of RPI. They're listed there. You can pick out the ones that you will like. I don't intend to go through them. But overall, what are the key findings from the exercise? Well, the opportunities to incorporate RPI strategies, they exist for all stakeholders. There are two types of financially sound RPI strategy: no cost and added value. No cost is self-evident. The manager finds ways to improve the social and environmental performance of his properties at zero expense. The most simplest form of all is switching the lights out in an unoccupied area. Simple. Added value strategies do require some financial outlay, but they pay for themselves either by increasing net incomes, either by higher or more rent, or lower costs, or reducing the risk premium from lower risks, from less depreciation, from less marketing costs. But the area that needs further research is that of metrics. Continued research to acknowledge, to understand, to interpret in a language universally understood by those in ultimate control, the men with the money. Let me just share a couple of examples with you from some of the practice that the Property Working Group have identified. On the screen you can see an example strategy. It's simple, it relates to energy procurement. It recognises the lower environmental impacts from renewable sources. It assesses that price premiums can be countered by bulk purchase or by energy efficiency measures, and suggests that occupiers may well be able to absorb price increases as part of their own CSR agendas. And here's such a strategy in practice by Prudential in the UK. A bulk purchase of green energy, which saves 21,000 tonnes of carbon, and also benefits from additional economies from tax exemptions. Redevelopment may be the slow lane, but it's still important. Here's a building in France, in Aubervilliers, 3 miles north of the centre of Paris, 10,000 square metres. Certified building under the French certification system. The thing about this particular building may well be evident from the slide, is that the glazing is triple glazing and it's non-standard. And immediately one would think massive costs, premiums to be paid. But the thing about this particular case was that the client challenged the architect and his team to come up with solutions to build a green building at no additional premium. Existing stock, and an example from the UK in London, and a property holding which is located just on the fringe of Oxford Street, the premier shopping street in London. Here we had a complete eclectic mix of retailers, office workers, leisure seekers, hoteliers and residents. There was an extensive and uncoordinated waste practice, and it was an issue for all those operating in the area. The local authority and the property manager worked together and came up with a new coordinated approach. Lessen noise, odours and inconvenience. It's very simple, a single disposal provider, but the challenge was simply to persevere and to overcome the inertias that many people had. Lots of national operators in there with their national contracts had to be convinced that it was better for the overall community. And now we have an improved shopping and leisure experience. And finally, at a portfolio level, with CalPERS in California and United States. The point here is that CalPERS, in their operation, have put these risks, have assessed the risks in these, and no different than they would with any other investment that they make. So to summarise, the future is not the past. Investors must have and will respond. Climate change is the big issue, and the concerns and responsibilities lie on the property managers. There is an impact on investment value, which drives a lot of this activity, but there are real examples of RPI out there. Certainly, the UNEP Free Property Working Group hope that the collection of examples will serve to demonstrate how investors in property can meet their social and fiduciary responsibilities. Doing well by doing good, a very appropriate mantra, and those that implement practices at the forefront can have their leap of faith rewarded by realising greater returns. Thank you.